the new F9 mocks. Now, my assumption is that you have already seen it before. Okay. Just in case if you have not seen it, I'll give you the time to read. Okay. Now, my aim is, first of all, that if you are in the examination, it's not about learning, it's about scoring more marks. Okay. So the first aim is to save time. Don't spend a lot of time. Remember, you have 3 minutes maximum available, right? Well, it's available a little bit more than 3 minutes, but we'll keep it to 3 minutes, right? In order to save time. You will avoid silly mistakes and you have to read the question very carefully. It's a very common problem that students sometimes they are in a hurry and they are not reading the requirements carefully. Third one, sometimes you don't have to understand the question completely. There is always a shortcut, not always, sometimes there is a shortcut available and you can do it in an easier way. Okay, so we'll start with the first question, right? So I'll ask you to pause the video and read the question carefully. Now let's see it together. The following are the extracts from the financial statement of ACCA, okay, and what's required. Cash operating cycle using the working capital ratios and to the nearest day. This is the silly mistake that I was talking about. Sometimes you don't read it carefully, so you have to read it very carefully. Okay. Now, cash operating cycle, it's quite straightforward. You have inventory days, you have plus receivable days, and you have to deduct the payable days. Okay. Now, just in case if you don't remember the formulas, it's inventory divided by cost of sale into 365. But in this particular question, it says that you have to assume that there are 360 days. Okay, so that's multiply by 360. For receivables, it will be receivable divided by the credit sales into 360. And then you have the payables. So you have payables divided by purchases, right? So if the purchase amount is not available, then you are going to use cost of sale for this also. Multiply by 360. Okay. Now let's see what do we have in here. You see, revenue, 10% are cash sales. So remember, we're not interested in the cash sales. We are interested in credit sales only. So if it is 3,800, then we'll have to multiply it with 90% to get the credit sales. So the credit sales are 3,420. Okay. Then the cost of sale is given, but then it says that 80% are purchases. So that's what we are going to use over here. So 2,700 multiply by 80% will give you 2,160. So the purchase will be 2,160, right? Okay, let's start solving it now. Inventories is given to you 350 divided by the cost of sale, which is 2,700 multiplied by 360. For receivables, it's the receivables amount 420 multiplied by sales, which is the credit sales. We said 3,420 multiplied by 360. And then the third one is the payables, which is 250 divided by purchases. Okay, so just in case if this is not given to us, we are going to use cost of sale. But this time we can calculate it, so let's do it. Okay, so 350 divided by 2,700 into 360. This will be 46.66, but we'll avoid that because we have to do it to the nearest day. So you can say it's 47 days. Round it now. Then we have 420 divided by 3420 into 360. So that will be 44 days. And then the third one, the payable days, 250 divided by 2160 multiplied by 360. So that will be 42 days. So 47 plus 44 minus 42 will be 49 days. So this is the answer. Okay. Even if you don't round it, I believe that you are still going to get the same answer. Okay. Because the difference is quite huge in these two. Now, this question, if you have noticed, it has taken a little bit extra time because more calculation is involved. Question wasn't difficult at all. It was a very straightforward question, but it took a little bit extra time. Now, the tricky things, the common mistake that students do is, first of all, to use the cost of sale figure in here. If you can calculate purchases, so you have to do it. Okay. And then maybe some students may have used this figure instead of the credit sales, right? So you have to be careful with these two. And the rest, I think the answer is quite straightforward. Okay. Let's see the second one. So I'll again ask you to pause the video and read the question. So here you can save the time now. If you see, there is no calculation is involved. Okay. So which of the following is our weaknesses in using the financial statement to value an unlisted business? Okay. So 2 points are important in here. But you see, it's a knowledge testing question. There is no calculation involved, so you can save time, right? Now, if you see the requirement, the financial statement are governed by financial regulation. Well, this is not a weakness. Okay. This is not a weakness. So let's eliminate this one. Then it says, financial statements do not represent the future performance. This is true because the financial statements are basically backward looking, right? You have the past results and you basically compile them together to make a summarized financial statement, right? So basically when you have to value a business, right? So basically it's a future decision. So this is based on past. So yes, this is true. Then it says financial statements are produced on annual basis. Again, it's on annual basis, so you don't get the real-time data. Okay, so it means that it's not very useful for valuation. So this statement is also true. So 2 and 3 are true. So this is the right answer. You see, you have saved a lot of time. Yes, in the first question, it took a little bit extra time, but this time you're saving some time. Okay. Let's see the next one. Let's read it. You read it. I'll pause it. Let's see it together now. Okay. StoneCo is expecting to deposit 25 million in 3 months' time. The deposit will be for 4 months, right? So it will start in 3 months' time, and then it will go for 4 further months. Okay. So 3 to 4, 4 to 5, 4 to 6, 3 to 4, 4 to 5, 4 to 6, 6 to 7, right? So that will be 4 years. Okay. Okay, StoneCo is concerned with the interest rate could fall. So this is basically our risk over the next 3 months. It wants to fix the rate of interest now. So it's from hedging, and the forward rate agreement will be done. Okay, FRA has been obtained and the following quotes are available. Okay, now you see there are 2 FRAs available, right? So which one is yours? You have to choose that. Okay. Now, first of all, it's starting from 3 months, right? And then it will go for 4 months. So it means that this is the right FRA, 3 to 7. Okay. FRA 3 to 7. But then there are two interest rates given to us. So which one is ours, right? Remember, we are going to deposit. And our risk is that the interest rate would fall, right? So it means that in order to deposit, we are going to fix it with the lower rate, so which is 4.7, right? So let me write it for you just in case if you don't remember. Deposit risk is that interest rate will fall, okay? Therefore, we use lower rate, which is 4.7%, right? Just in case if it was loan, which is not the case right now, right? Then what will be your risk? The risk is that interest rate will increase, right? When you take the loan, then you pay the interest. You don't want to pay more, right? So the risk is that you will pay more, and therefore you are going to use the higher rate to fix the interest up to the maximum of 5%, okay? Which is not the case right now. Our case is the first one, deposit, okay? So we are going to use this FRA, right? Starting from 3 months and then going for 4 extra months after the third month, right? This is not the right one, okay? This is basically just 1 month if you see, 3 to 4, okay? Now, assuming that the interest rate is 4.3% in 3 months' time, this is the actual interest rate, okay? This is the actual situation that has happened, okay? So let's calculate that after 3 months, how much actual interest we will be paying, right? So actual interest, right? So if it is 25 million and you are doing it for 4 months out of 12, and the annual interest rate is 4.7%, so 25 million into 4 out of 12 into 4.7%, so which is 0.391 million. So if you convert that into millions, so that will be 391,667. Oh, no, that's not the actual interest. Basically, that's the FRA one. Right? The FRA, the actual one is 4.3%. So we'll do that next. 391,667. And then the actual interest, 25 million into 4 by 12 into 4.3%. So basically, you ended paying less, but because you have fixed it, so now whatever is fixed, the additional amount you'll be paying into the bank, okay? So 25 million into 4 by 12 into, so changing that into millions will make it 358,333. Okay, this is going to be 391,667 minus the answer, which is 333,333. Okay, if you see, this is the right option. So basically, you were supposed to pay this much interest, right, which is a bit less, but because you fixed it already, so now this additional amount is the one that you'll be paying it to the bank, okay? So assuming that if the rate is this much, what will be the financial settlement, right? So this is the financial settlement. This is the amount that you'll be paying it to the bank, okay? So again, it wasn't a difficult question, quite straightforward, right? But yes, because calculation is involved, so it took a little bit extra time, okay? Let's see the fourth one. Again, pause the video. Again, you can save some time now because there is no calculation involved. Calculation takes a little bit extra time. So it says, select the type of financial market appropriate to each of the company needs. Okay. Now, the first company, MBCO, needs to convert foreign currency into domestic currency. Okay. Which market are you going to use if you have the foreign currency and you want to change that into your local currency? The foreign exchange market, right? The euro currency market, just in case if you don't know, right? Or you might have heard the word euro bonds, if you remember, right? So euro currency market, let me give you an example, right? So let's say if you have US dollars deposited into, let's say, London, so that will be called euro dollars, right? So it's basically the foreign currency deposit in a different country, for example. Okay, it doesn't mean that it has to be euro currency. Okay, remember, like, see, this is not euro, right? This is euro dollars. Okay, it does not have to be euros. Remember that. It's just the foreign currency deposit. Okay, the second one, it says DILCO needs to issue new long-term loans, right? So for long-term, we have the capital market. For short-term, we have money market. Okay, so it's the long-term, so capital market. Then Benjico needs to issue new ordinary shares. So if it is new ordinary shares, so again, it's a long-term market. So you have capital market on both sides, but it's new shares, so you have the primary capital market. Okay. Then the next one, Carloco needs to purchase short-term over-the-counter derivatives. Okay. Short-term will be money market. Okay. So it's the short-term money market. Now, let's see the next question. Okay. Again, pause the video, quickly read it. Seems to be like a shorter question. Again, a shorter question, right? Though calculation is involved, but I believe that you can do it quickly. Okay. So what is the cost of equity? Again, to the nearest percentage. Remember, this is very important, right? Especially with these kind of questions. Okay. So you don't have to do any decimals. Okay. Buckland Marsh Co has current market capitalization of 58 million. So this is the market value, and has recently paid a dividend of 5 million. So this is the dividend paid. Dividend payout ratio is 70% and return on equity is 20%. Okay. So it means that for the growth, they are using the Gordon growth model. So let's calculate the growth first. Now, for the Gordon growth model, it's R and B. B is the retention rate, R is the return on reinvestment, right? So sometimes the examiner may call it return on reinvestment. Sometimes the examiner may use the word like return on equity, because this is also the same thing, right? You reinvest your equity. Okay. So return on equity or return on the reinvested funds, 20%. Now, the payout ratio is 70%. Now, let's say, for example, if you have the profit after tax, if you pay out 70%, it means that you are retaining 30%. The remaining 30% is retained. So again, a common mistake is that students sometimes use 70% over here. So it's the 30%, the remaining amount. Okay. Okay. So 20% into 30% will be 6%. So this is the growth rate. Now, the cost of equity formula is D naught into 1 plus the growth rate divided by P naught plus the growth rate. Now, you might be wondering that, well, we have the dividend not given per share over here. And instead of the price of the share, you are given the total market value. Okay. Well, if you are going to use the total in here and in here, it's going to give you the same answer, right? It will still give you the cost of equity. So cost of equity dividend, which is 5 million into 1 plus the growth rate, 1 plus 6% divided by, instead of the share price, it will be market capitalization 58 million plus the growth rate 0.06, and this should be your answer. You see, to the nearest percentage, so that will be 15%. So I'm just going to write 15. Again, you see, I just told you not to do the silly mistake and I was nearly going to do it, right? Don't put the percentage sign, it's already there. Okay, so just write 15 in here. Okay. So again, not too bad. You can do it within your given time. It's quite straightforward. And even if it takes a little bit longer, you see the next question is also does not have any calculation. So I believe that you can save some time over there. Okay, let me pause it. You pause the video and read the question carefully. Which two of the following are true? So again, how do you save time in here, right? You're given four answers. If you can easily find out the first two correct answers, then you don't even have to read the next one. Okay, this is how you can save time. Remember, I told you that it's about time saving and it's about looking for the shortcuts. Okay, examinations are different. In examination, you have limited time. Okay, the finance director of Tracker is analyzing the yield curve in euro market to select a suitable financing strategy. He observes that yield curve has recently changed from normal yield curve to inverted yield curve, right? So just in case if you don't remember the normal and the inverted yield curve, so let me show you in here. Let's say the normal yield curve is upward sloping, okay? This is the time to maturity. And the inverted yield curve is going to look like this, right? So basically with the passage of time, with the normal yield curve, the return is increasing. But in the inverted yield curve, the return is reducing when the time is increasing, right? And it says that it has changed from normal to inverted. So this is what we are interested now, right? So it's going to change into this one, the inverted yield curve, okay? Now, the first one says bonds with longer term maturity will have lower returns. Well, yes, this is right. So we got our first right answer. Then it says Tracker is exposed to rising interest rates into the euro country, right? It's not the interest rate is not rising, the interest rate is reducing. So this is wrong. Okay. Let's see the third one. The change would have been beneficial for Tracker if it has issued long-term fixed rate debt before the inversion, right? So you see, if it is fixed, how can we get the benefit of borrowing the cheaper loan, right? So the variable will be actually more beneficial. Okay, so this is because of this will be actually wrong. Now again, if these two are wrong and two of them are correct, so of course the fourth one will be correct. So even without reading it, we can say that, okay, in the real examination, if I'm sure that these two are wrong, maybe I'll not even read the last one, right? But let's read it. Raising euro bonds financing into euro currency has become more attractive, right? So yes, because this is first of all long term, right? So we can benefit from the lower interest rate. The interest rate are getting lower, so we can benefit from it. Okay. So again, you see, no calculation, so you save time. Though, like you see, you don't have to draw these down in the real examination. It was just for your understanding and a quick revision. Okay. The seventh one, pause the video and read it. Which of the following is an illustration of principal agent problem, right? Now, as soon as I see this question, right? So the principal and the agent relationship, right? It's about the director and the shareholder relationship, okay? So I'm not, to be honest, in the real examination, I won't be interested in all four of them. I've seen the word director in here and shareholder in here. So maybe these two statement, one of these two statement will be the one in which I'm interested. So let's see the first one. Directors avoiding debt finance because lower interest payment increase their job security. Yes, that's the agency problem, right? So we don't even have to read the next one. Well, just for your understanding, remember, debt is risky and directors may lose their job, right, for taking a lot of risk sometimes. But remember, debt is cheaper. Now, directors may not want to take this risk, right, and deprive the company or the shareholders of the company, which are the principal, from the cheaper financing option. Okay. So this cheaper financing option will increase the shareholders' wealth, remember, right? So this was the shortcut that I was talking about in here. Shortcut answer. Sometimes you don't have to read the full questions in the real examination because time is, of course, very important in the real examination. Okay. Let's read the eighth one. Quickly read it and pause the video. Again, a little bit calculation is involved in here. So under which investment appraisal method using the company's target will the project be accepted? Okay. So we can see that there are two investment appraisal methods. Return on capital employed and payback period is given to us, right? The project has an average cash flow per year this much. So this is the cash flow per year with an initial investment of 9,000, no residual value. Depreciation is straight line, and the project has a 6 years lifespan. Okay. Company's target return on capital employed is 28% and target payback period is 2.5%. The return on capital employed is on average method basis. Okay. Now we have to unfortunately do the calculation this time. Okay. The return on capital employed, remember the formula is the average profit divided by the average investment. Okay. Are we given the average profit? We are not given the average profit. Okay. We are just given the cash flows, and that's the cash flow per year. So we have to calculate it. Remember, profit is equal to cash flow minus depreciation. Okay. Now, cash flow is per year. So if it is for 6 years, that's going to be 3,000 multiplied by 6, which is 18,000. Depreciation is investment minus residual value. Residual value is 0. So investment minus 0, 9,000 minus 0 will be 9,000, right? So this is going to give us the profit of 9,000. But this is the overall profit, remember, okay? We need the average profit, okay? So the average profit will be this divided by the number of years. So 9,000 divided by 6 will give us 1,500, okay? Average investment, which is the initial investment, plus the residual value divided by 2. So 9,000 plus 0 divided by 2 will be 4,500. So 1,500 divided by this will be 33.33%, right? We can clearly see that it's more than the target, right? So of course, this answer is wrong, payback basis only, and we can say that both of them are correct. This is possible, but neither, right? Just in case, if I don't know the next calculation, just in case, okay? So I can say that my answer is either this or this. So even if I select one of them, there's 50% chances that I'm going to get the right answer, right? But let's do the next one, payback, right? Well, I'm just discussing that. Just discussing that with the assumption that, look, guys, you are sitting in the real examination, okay? So even sometimes if you have to do some guesswork, right? So you can basically increase your chances that your answer will be correct, okay? Okay, payback period. The payback period when we have cash flow per annum fixed, right? Because the cash flow per annum is 3,000, right? The calculation will be quite easy. That will be investment divided by the cash flow per annum. So investment is 9,000, cash flow per annum is 3,000, right? So this is going to give us 3 years, right? Now you see, you don't even have to do this calculation. You can even do this in your head, right? 9,000 divided by 3,000. So that's going to give you 3 years. And you can see the payback period is 2.5 years. So our payback period is more than that. It should be less than this. Okay. So it means that only return on capital employed is going to help us select this on this particular project. Okay. For payback period, we will not accept the project. Okay. Let's see the next one. So calculation was there, but I don't think so it was too long, right? I think like within 3 minutes it can be done, right? I may have taken a little bit longer time because I'm trying to explain it to you. You don't have to explain it to anyone in the real exam, okay? Now let's see the next one. Pause the video. So which one of the following performance measure would best fit with effectiveness in the value for money audit? Now, effectiveness, you need to understand, first of all, what is effectiveness? Effectiveness is about your target, when the target is achieved. Right? So you have achieved what you wanted to do, right? So let's say, for example, if you are in a college, so when the student will pass, so we can say that the college is effective, right? What does that mean? It means that the target that we were supposed to acquire, we have achieved the target, okay? So let's read it. Average hours to train. Okay, what's this about? Guide Me is a charity that was set up with the objective of training dogs. Okay, for blind people. Okay, for blind people, we are training the dogs. Okay, so average hours to train the dog. Well, average hours is not about effectiveness. Okay, number of dogs awarded with the Guide Me certification standard. Okay. So if they got the certification, it means that the dog is trained. This is what we call effectiveness, right? Dog certified, target achieved, effectiveness. That's it. We don't even have to read the next one, right? Okay. The others can be either economy or efficiency, but we are just interested in effectiveness right now, right? So easy. And you see, you can save time in this question. Okay. Let's read the next one. Pause the video. Which of the following statements are correct? The statements is correct. Okay. Oh, okay. So which of the following statements is correct? Okay, so one of the statement is correct. Okay. Elaco has decided to invest in a new machine and has a 7 years lifespan and has no expected residual value. Residual value 0. Machine can be purchased outright for 80,000, right? So in the buy option, you can buy it for 80,000 using 8% loan, right? Remember, if you're buying it now, it's already in the present value term. Okay. So this is also always the case then, because you're buying it now. So there is no time value of money calculation involved in here. Alternatively, it can lease it for 7 years by paying annual lease for 14,983, which must be paid at the end of each year. At the end of each year, we are going to pay this for 7 years. Okay. So most probably it will be about like which one we have to select. Okay. Like the lease option or the buy option. So I think we'll do a quick calculation. The buy option is 80,000. In the lease option, if you calculate the lease payment, 14,983, right? Now you can see the discount table, it will be given to you, but I think like if you do the calculation, you can do it quickly, right? You don't even have to scroll back and see the table, right? So the formula was 1 minus 1 plus r raised to the power minus n whole divided by r, where r is basically your discount rate and n is the number of years. This is the annuity formula, okay? 1 minus 1 plus the discount rate, so 1.08. 7 years, so minus 7, divided by the discount rate 8, okay? Now, those students who are basically doing it for the first time, right? Sometimes some students actually rely a lot on the tables, right? So the quickest way to do it, to solve this first, 1.08 raised to the power minus 7 is equal, and then you'll say 1 minus this. So 1 minus the answer, right? And then divided by 0.08. This is going to be, okay, I think we did something wrong. Okay, 1.08 raised to the power minus 7. 1 minus the answer divided by 0.08. That is, what's going on? 1.08 raised to the power minus 7 is equal to, then 1 minus the answer is equal to, divided by 0.08. Okay, so that's 5.206. And you simply multiply it with this figure, 14,983. So that's 78,007. We can clearly see that it's actually lower than the buy option. So we are going to lease it. We are not going to buy it. Buy option is a bit expensive, right? Now, if you see the first one, the machine should be purchased. Well, I'm not going to read it completely because the machine is not going to be purchased. The machine will be leased, okay? Because the option is lower. No, the option is not lower than leasing. It's wrong. The second one, Maurako should not agree to either from the financing because both will, you see, definitely this is going to be a negative NPV. Lease versus buy option will give you the negative NPV. Why? Because we are just considering the financing cash flows. We are not considering the operating cash flows, right? So the negative NPV doesn't mean that we were not accepted. We already said we have decided that we will accept the project. We will invest in this new machine, right? So always it's going to be negative. So it doesn't mean that we will not do it. So this is wrong also, okay? Now, those students sometimes like you just memorize it. Okay, negative NPV, reject the project, okay? So you have to look at this more logically. In lease versus buy option, you have to see which option is cheaper. As far as the negative NPV is concerned, it will be negative. Why? Because you just have the financing cash flows. Okay, financing will be all negative. Okay. Machine should be leased because this option is lower overall cost than the purchase. Yes, we said leasing option is cheaper, so we'll go for this option. Now, yes, calculation was involved, right? But if you look at the calculation, that was quite straightforward. right? I've just given you the steps. You don't even have to write the complete steps. You can do it in one go using your calculator. Like for example, if you just want to do it directly, so 1.08 raised to the power minus 7, 1 minus the answer divided by 0.08 multiplied by 14,983. So this is the overall answer. You can simply look at this, compare this, and you'll say, I'm going to lease the machine. Okay. So this calculation is not required. It was just for your understanding. Okay. Okay. Let's see the next one. Again, pause the video and read the question carefully. Which two of the following statement concerning the impact on government decision is true? Okay. So Alightco is planning a major investment in new manufacturing unit in next year. Due to recent concerns that the inflation is too high, the government has unexpectedly announced the increase in the interest rate, right? So in order to stabilize the inflation, the government has increased the interest rate. So what will be impact on us, right, as a company? The company's cost of capital will decrease, right? This is wrong. Remember, when the interest rate is increased, so it means that our cost of debt will increase. And when the cost of debt will increase, it means that our cost of capital will also increase, right? And when the cost of capital is increased, okay, cost of capital will decrease. Okay, so this is wrong. When the cost of capital will increase, it means that NPV of the projects will also reduce, right? It has not been asked in here, but this is the first one, so this is wrong. Okay. So I just wanted to show you that what will be the impact on the business when they do the investments. Okay. The second one says, this is an example of expansionary monetary policy, right? Well, of course, when the investment is getting discouraged, as we said in here, so it's not expansionary, it's actually contractionary monetary policy. Okay, so this is also wrong. The next one says, now, two of them are correct and the first two are wrong. So now I can say that, okay, third and fourth are also correct. Okay, without even looking at the answer. In the real examination, if I'll be in your place, I would have just selected this and moved to the next question, right, in order to save time. Okay. Demand for the company's product may reduce, right, or decrease. Demand for the company's product may decrease. Now, you see, when the interest rate has increased, then it means that people are not going to borrow less. People are not going to borrow more. Okay. So if people are not going to borrow more, if they're going to borrow less, they will be spending less also. Right. And if they're spending less, demand is going to reduce. Right. So this is true. The next one, NPV of the investment will be then lower than the initially expected. As we just mentioned in the first one, NPV is going to be lower, right? So this is also true, right? So see, you can save a lot of time when there is no calculation involved, okay? Unfortunately, we have some calculation in the next one. So I'll just, again, pause the video and read the question carefully. What is the theoretical X-right price per share with the rights issue price per share? Okay, so two calculations are required, theoretical X-right price and the right issue price. Okay. Okay, the company is planning for 144 rights issue. The value of the right has been calculated 0.5 per existing share. This per existing share, this is actually very important to notice. Okay, so this is not just value of the right, this is value of the right per existing share, right? And what are the existing share? When we say that 144 rights issue, it means that at the moment we have 4 existing shares and we want to issue one more. Okay, so 144. So existing share are these four shares. Okay. The company's market price currently is $8. Okay. So what is the theoretical ex-right price and the rights issue price, right? It should be one of these seven calculations. Okay. So let's calculate the theoretical ex-right price first. Now, the theoretical ex-right price will be your current market value minus value of the right per existing shares. Okay. The current market value, which is $8, and value of the right existing share is 0.5. So that will be $7.5. So theoretical ex-right price calculation will be here. Okay. So this one. Now, the second one is right issue price. Right issue price is a theoretical ex-right price minus value of the right. Okay. I didn't say for existing shares only. I said value of the right. So for existing share, if it is 0.5, then for the four shares in total, it will be 0.5 multiplied by 4. Okay. So half, 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 half will make it 2. So that's $2. So 7.5 minus $2 will be 5.5. So which one is this? This one. Okay. So issue price. Okay. So, well, yes, calculation was there, but it wasn't very long. Okay. Let's see the next one. Again, pause the video and watch it carefully. Now, looking at the size of this question, right? Seriously, at this time, you want to slap your examiner, right? Just for 2 marks. I mean, so many things are given to you for reading, right? But again, you see, when you see it carefully, you are going to look for a shortcut. Always, when there is a long question, right? I mean, a long question means like for a 2 marks, if it is very long, right? The examiner must have given you a shortcut for that. So you just have to identify that. That's the aim. So it says, what will be the ordinary share price at the end of today if the capital market is semi-strong, form efficient, and strong form efficient? So basically, what will be the share price if the market is semi-strong and if the market is strong form efficient? Okay. It says the company is listed company which has 4 million ordinary shares in issue. Okay, the number of shares. Yesterday, the ordinary share price closed at $5. So yesterday it was $5. 2 days earlier, the board of directors approved the launch of 2 new innovative products, but this has not been publicly announced. Okay. Now, I'll tell you the shortcut later on, but look, right now, what is happening? We need to understand that when is the semi-strong form efficient market going to react, right? And what is the strong form efficient market? The strong form efficient market in real world, to be honest, doesn't exist, right? Because it means that all the investors, everyone in the market, right? They have all information. They have the past information, present information, and the future information also, right? Well, the past and the present is fine, but the future information, of course, that's not possible. But this is what we call strong form efficient market. Okay. Now, with the semi-strong form efficient market, we have assumption that we have the past information and we have the present information, which is what we call the publicly available information, right? So strong form efficient, past, present, future. Semi-strong efficient market, we have the past and the present information, which is the publicly published information. Okay. Now, product A has an NPV of this much. The decision to launch product A will be announced publicly tomorrow. right? So if it has not been announced, it's not going to be reflected in the market value in semi-strong efficient market. We are just focusing on semi-strong efficient market first of all, okay? Because it will be announced tomorrow, right? So we want to see what will be the price today, okay? Product B has an NPV of 160 million. The decision to launch product E will be announced publicly this morning. Remember, we want to see that what will be the share price at the end of today. So in the morning, if it is announced, then of course, this will be reflected in the share price today, okay? And now, if the NPV is 160 million, and we have overall 400 million shares. So per share is going to give us a benefit of, or the NPV for every share will be reflected in the share price of 0.4. So if the share price is $5, with this announcement, additional benefit will be $0.4. So it means that the semi-strong efficient market will give us $5.4 share price by the end of today. So which one is this? Option 3. Now look, if this is option 3, we don't have to do the next calculation, okay? This is one shortcut, right? But can we actually do it in even shorter way without any calculation? Look, if the share price currently is $5, it means that currently in a strong form efficient market, now we are discussing the strong form efficient market. If the share price currently is $5, right? So it already reflects what will happen in the future, what has happened in the past, what will be announced publicly, right? So it already reflects everything, right? So in a strong form efficient market, it will not change, right? It will remain $5. Now, just in case, if you have not done this calculation, and if in strong form efficient market, if it is $5, right? The only $5 option is available in the third option, which is option 3. So it means that you don't even have to do this calculation, right? So even without calculation, you can find the right answer. This is what I was talking about, that in the real examination, you have to think about time saving, okay? Now, so you can answer it within like 5 to 10 seconds after reading the question, of course, okay? Let's see the next one. Pause the video and watch it. Again, no calculation involved, so we can save time. Which of the following statement concerning the traditional theory of capital structure is correct? Okay, so one of them is correct. There is an optimal capital structure for the company where the market value is maximized. This is correct, right? Remember, in traditional theory, right? So let's say, for example, if this is the line for the debt financing, right? And your overall weighted average cost of capital line is going to look like this, okay? So at this point, this is the capital structure, debt to equity ratio, at which the weighted average cost of capital is minimized. When our cost is minimized, our market value is maximized, right? So at this point, when the cost is minimum, the market value will be maximum, right? So the optimal capital structure basically means that the debt to equity ratio, which will minimize WACC so that we can have maximized market value of the company. Okay. So again, a very straightforward question without even reading the next 3 options. You can simply say, okay, the first one is correct. Okay. Let's see the last one and quickly read it, and then we'll see it together. Pause the video. Which two of the following statement concerning the interest rate risk management method is smoothing? Okay. Okay. Now, smoothing basically means that you have a mixture of variable loan and the fixed loan. Okay. So the first option say, and two of them are correct. Okay. So the first option says the debt portfolio will consist a mixture of fixed and floating rate debt. Floating is the variable. This is by definition. So of course, this is correct. Okay. Then the next statement says, interest payment will still increase if the interest rate rises. This is also correct, right? Interest payment will still increase if the interest rate rises. Remember, we have mixture of fixed and floating rate. So if the interest rate rises, then because of this floating rate, of course, we'll have to pay more. Okay. So because of the fixed loan, we can say that it will be minimized, but it will not be eliminated. So we'll say reduces change in interest rate. But does not eliminate. Right? Now, again, two of them are correct. We don't have to read the next three. If we are sure that the first two are correct, we don't have to read the next three, right? If you will read it, of course, you will waste time in the examination. Okay. Well, let's say it says investment with the fixed cash flow will be financed with the fixed rate debt. Okay. This is what we call matching strategy. This is not smoothing. Okay. So fixed inflows are coming. So we have the fixed debt so that we can use this to pay this. Okay. The full benefit of obtaining all from the fall of interest, right? Full benefit will not be obtained, as we discussed above also, that if the interest rate is, let's say, increasing, so because of the floating rate, we'll be ending up paying more. Okay. And if the interest rate has reduced, so we will not get the benefit because some of the amount will be fixed. So we cannot get the benefit of reduction in the interest rate also, right? The net effect will be that the interest payment, which will be fixed. No, not all of them, because smoothing is about having a mixture of these two, right? Mixture of fixed and the floating debt. All right. So you might have noticed that it was 15 questions, right? We can do it very quickly. We can save time by not reading the things which are not required, right? We can avoid silly mistakes. What were the silly mistakes? Like by, for example, the nearest day in here or the nearest percentage in one of the question right here, right? So these kind of things will not be ignored, or it should not be ignored, right? And then we have some shortcut answers for some of the questions. You might have noticed that two or three questions had comparatively shortcut answers available, right? Like you could have done it easily by giving it less time. Okay.